Hello and welcome back to All Things Money. I'm your host, David Blain, and during this segment we'll finish wrapping up talking about dividend investing and what the impending tax hikes mean for dividend investors. If you missed the last segment or the first segment of the show where we talked about some of the problems that France was having, head on over to our website, www.dlblain.com, and click on the Knowledge Center. There you'll find both video as well as audio archives of the show and numerous articles that we've written over the years. It's really a great source of information. There's a search box there. You can type in what you're looking for, and it will bring up all the TV and radio shows and articles that we've written on that topic. So we're talking a little bit at the end of the last segment about dividend investing, and for a North Carolina taxpayer in the highest tax bracket, dividend investing, you're going to lose over 50% of your dividends to taxes if the proposed tax hikes do in fact, or the tax hikes that are on the books now do in fact take place January 1, 2013, if no one does anything about it. And so sort of the luster of dividend investing is going to lose some of its shine. And it's a shame because if you look historically at the returns of the market, a fair percentage of the total return of stocks comes from the dividends. And of course, bond investing, if you buy and hold a bond to maturity, all the return of bond investing comes from interest income, which also is taxed at your ordinary income rates. And so I'm focusing on dividends here, but this also applies to interest from bonds. So if you, other than municipal bonds, which of course are federal and state tax exempt, and treasury bonds, which have some tax preference as well. But if you take a regular bond that's paying 3%, or a stock that's paying a 3% dividend, if you're in the highest tax bracket, you're talking about losing half of that to dividends. Now, of course, over the years, companies have reduced the payout rate. Some companies pay no dividends, but a lot have reduced the payout rate and have engaged in share repurchases, which are a tax-efficient manner of actually giving the shareholders a dividend. So, for example, if there's I'm going to keep this simplistic. Public companies have millions and billions of shares outstanding. But let's just say a company has 1,000 shares outstanding, and they have some extra money that they've earned. Well, they could pay out a dividend to those shareholders and actually send them a check, to the 1,000 shares. Or what they could do is they could buy up some of the shares with that excess money. Let's say they have, $1 million extra money. They could either pay it out to the investors in dividends, or they could buy their own shares of stock and take them out of circulation. So, for example, our hypothetical company that has 1,000 shares, instead of paying out a dividend, let's say they had enough money they could buy half the shares. And so what happens, of course, in a supply and demand market is two things. One, you have the company going out on the market and demanding the shares, so that helps lift the share price. The other thing that happens is once they buy those shares, they retire them, and they become what's called treasury stock. I don't want to go into, bore you with accounting details, but they're basically retired. And so now, let's say there was 500 shares outstanding, and so now those 500 shares, the percent ownership of the company has doubled for the people that own those shares. So the shareholders that own it, even though they didn't get a dividend, by the company engaging in share buybacks, has actually increased the value of those shares. And here's kind of the point of that is, and they don't pay tax on that. They choose when to pay tax on it, if they were to sell it. Of course, in the future, if the company resumed or raised their dividend, now there's less shares outstanding, and so more of it goes to that individual shareholder that retained their shares. So we see that share buybacks have become a much greater portion of shareholder compensation than in the past. When we looked out back in 1960, companies paid out roughly 60% of their earnings in dividends. Of course, in 1960, the highest tax rate on dividends was 91%, but that's another story. When we look at the payout rates today, they're down in the 30 to 40% range, and so companies are paying less of their money out in dividends and retaining more for growth. Some people would argue that retaining the money and spending it on acquisitions or growing the company, a lot of times those ideas don't work out. But the idea is that the company, rather than sending the money to the investors, can make the company more valuable by reinvesting that into their company. And so we see historically companies would pay out 60% of their earnings to the shareholders, and today we see a much less proportion going to the shareholders. And so the question becomes, with the new tax policy, as people see the tax rate go up on dividends. Now remember, a dividend, a lot of people don't realize this, but for the corporation, the dividend is not deductible. So for example, if a company makes $1 million and they pay it all out in dividends, $1 million in dividends, they still owe income tax on $1 million. So actually they can't pay out all their profits to shareholders. The most they could possibly pay out would be their profit minus the tax. Let's say the tax on $1 million is 35%. So they would have to take $350,000, send it to the IRS. That leaves $650,000 of that profit to pay out to shareholders. So the company does not get a deduction for paying the money out to the shareholders in dividends. So in effect, that dividend is already taxed once at the corporate rate, say 35%. They pay it to the shareholder. Now the shareholder has to list it on his tax return. As we already mentioned, it could be as high as 50%. So you're talking about between the corporate rate and the individual investor rate, that dividend is taxed at 85%. This also doesn't take into account that investor had to earn the money, pay tax on it, and what was left, then he was able to invest. And so, we're really, by having such high capital gains and dividend rates, we're really discouraging people from investing. Well, that's about all the time we have for today's show. I hope you enjoyed listening. Maybe we'll pick up and talk a little bit about some more of the impending tax hikes that are coming next year. They're going to affect people in a lot of different ways. So for All Things Money, I'm your host, David Blain, and we hope to see you again next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.